In this video, we'll look at trading crypto futures on Kraken. I'll explain what they are, how to trade them, and then some of the specifics of the Kraken platform. So you can see I've got a futures trading account right here. That's different to your spot account. So if you don't have this, go to trade, and then top left, click the currency pair, go to spot and margin and futures, click one of these, and then I had a box here that was terms and conditions that I had to accept. So I accepted that and I can trade. Now in some regions and for some users, this may not be available. So you have to check if you can actually trade futures where you are and your account type as well. But I've got a futures account here. So if I click this, this is a separate account where we can trade futures contracts and we can put some assets in here to go and trade with. I'll explain this in a second, but this is your futures account. And this is important for how Kraken actually fund their futures contracts. If you haven't got a Kraken account yet, I will leave the link below to sign up. I'll leave some beginner's guides to Kraken as well if you need to know how to get money in and out of the platform. They are a great fiat currency on and off ramp for sure in G7 nations. I'll leave some deposit and trading bonus links to the other exchanges I use down in the description as well that also give futures trading if you want to trade futures. Different crypto platforms have slightly different ways of trading futures, and so I'll show you how Kraken do this. So Kraken have one account that you can put assets into, and they use the US dollar value of those assets as collateral to trade with. So when you trade in the spot market, you need to exchange assets immediately, which means you always need money there to buy something else. Well, with futures, you don't need that. What you only need is collateral to fund potential losses. So I can put 1,000 USDT in here and I've got 1,000 USDT to pay for potential losses. I can go and open up trades in the market worth $1, $2, $3, $4, $5,000, no problem. As long as I have money to pay for my potential losses, then Kraken will let me have these positions open. The way that Kraken do it is that they have an omnibus account where you can put multiple assets in. So you can put stable coins in like USDT, but you can also put fiat currencies in here, and you can also put cryptocurrencies in here. And what they do is they take the mark-to-market US dollar value of that, and that is the collateral that you have. And that is used to fund any positions that you have. So you can take some positions, and if you take a position and it goes into a profit, you also gain equity in your account, which can be used to fund positions. That's known right here, margin equity, right? So I don't have any equity right now because I've just got this amount of tether and I haven't got any positions. So that's my equity. But if I made a trade and got into profit, my account will actually have extra value, extra equity there to pay for any other positions. Now, if you have one position that's in a big profit, that can be used to pay for other positions that may be in a loss at the current time. And it's the net balance of your profit and loss that's the important thing. As long as you have enough collateral to pay for any potential losses that you have, you're going to be fine. Of course, if your collateral value falls, then that's not good, and you can begin the process of getting stopped out, which is basically they margin call you, which is they send you a message or an email saying you don't have enough collateral to pay for your positions, and then eventually they actually liquidate you, which is selling your assets to pay for any potential losses that you have. Obviously, we don't want that to happen. So I'll show you how this works on most exchanges. You have collateral that you put in your future trading account. Kraken has stablecoins and coins in there, and it uses the US dollar value of that to go ahead and trade. So whatever you have, the value of that, you can use that to go ahead and make positions. Now what you do after putting collateral in your account is to actually go ahead and trade. And you can trade with leverage, but the leverage only relates to how big your actual trade size is versus your collateral. So let's say I had $1,000 of collateral in here and I opened a $2,000 trade. I can do that because I have $1,000 to pay for potential losses in the $2,000 trade. And so that's fine. I can also open 3,000 or 4,000. It doesn't matter, right? Because you're just using the collateral to pay for any potential losses. But the more leverage that you take, the more leverage is used on each percentage movement in the price. So if you have $1,000 collateral and you open a $1,000 trade, then that's just like trading in the spot market. 1% is 1%. But if you open with 2x leverage, meaning you have $1,000 but you have a $2,000 trade, then that obviously increases the percentage movement in the market by 2, right? So a 1% move is like a 2% move, which means essentially a 10% loss on 2x leverage on $1,000 is not $100, it's $200, and so on. So if you use 5x leverage, you can open a $5,000 trade. If you use 10x leverage, you can open a $10,000 trade. But you're now making profits and losses on that position size, not on your collateral, which means a 10% loss on 5x leverage on your, your trade size is now $500 if you're using 5x leverage, and $1,000 if you're using 10x leverage. So if you're using 10x leverage, what that means is a 10% loss actually wipes out your original capital. So using leverage makes each percentage move in the underlying market much more volatile, and it can wipe out your collateral very, very quickly. On the other hand, it can obviously make you money to the upside as well, but we have to be aware of how much leverage that we're using, and that ties into taking risk in your trades as well. Kraken let us trade perpetuals, which is the most popular product in crypto futures. There are other products known as expiry date futures, which actually have a specific expiry date in the future that you can trade. We can't trade those on Kraken as of making this video, but the most popular product that most people trade is perpetual futures, meaning there is no expiry date to this future. You just open positions and close positions, and when you close your position, you make a profit or a loss, and that's it. The other thing we need to be aware of, though, when trading futures on Kraken is that because they're perpetual futures, there is a funding fee that is paid. Now, this is the same for every other exchange. You can see that up here, funding rate. So if you click this, it's going to show you the funding rates on Kraken over the times that they're exchanged. What is a funding rate? A funding rate is something that is required to be paid in perpetual futures markets on every exchange in crypto. And the reason is because, like I said, we're trading a derivative. We're not trading the underlying. So this is a completely separate market that we're trading, right? So this market here, it says Bitcoin USD, and we're trading at 95,000 right now, which is more or less the price of the underlying spot pair, Bitcoin USD, but not exactly the same. It's a different market, and it's open to its own supply and demand characteristics. And that's not good, because a futures contract that is aiming to track the price of Bitcoin USD has to track the price exactly, otherwise it becomes unreliable. But you can get buyers and sellers coming in, pushing the price away from the underlying price. So what crypto exchanges do is use the funding fee to try and get the futures price in line with the underlying spot market. So what happens when buyers come in is they push the price up. So the futures price is now above the spot price, and that's not good. They want to bring that down into the same price. So what they do is they make buyers who are pushing the price up pay a fee for doing that, because they want the price to come back down to the spot price. So that positive funding fee is paid when the futures price is above the spot price as a fee, and they pay it to the other side of the order book to sellers. So that's a fee that has to be paid when the futures price is above the spot price. Now the other side can happen where if sellers are coming in forcing the price lower than the spot price, then the futures price is lower, and that means that those sellers are pushing the price down. The exchange doesn't want them to do that, so they pay that funding fee to buyers, and hopefully the price goes back up in line with the spot price. So this is something that we have to be aware of, because if you have an open futures position, then you may either have to pay this or you can receive it. And you can't predict that because you don't know what the market is going to be doing. Most of the time in crypto, funding is positive, which means that the futures price is going to be above the spot price most of the time for the major assets, which means longs usually pay this. However, if sellers are coming in and the price is a bit weak, you may actually have to pay this if you're a seller as well. It's not really a big deal. It usually comes out at around 8 to 12% as a yearly figure that is paid, usually on the long side. So if you're long, you'll be having to pay that. So if you do have your position open for a long time, then just factor that into your trade and make sure you have collateral to pay that. And that's going to come out of any potential gains that you have in your position as well. But you may pay it, you may receive it. For the most part in crypto, it is positive. So you need to factor it into your trade and making sure that you are aware that you may pay it and it's going to take out of your profits, and you have enough collateral there to pay for that, because that funding is exchanged every few hours. Now we'll come to actually funding our positions using margin and then the amount of leverage that we're using. So the first thing is margin. How do we actually open a position? You need collateral in your futures trading account to open the position and have money there or collateral there to fund any potential losses. The way that you can do that is either through isolated margin or cross margin. Isolated, if we toggle this on, this means that this specific trading pair that you're trading has the collateral tied up in this trading pair isolated. That means if this trade or this trading pair goes south and you lose money, it doesn't contaminate your other positions. You just wipe out your collateral for that position. Cross margin means you're using all of your assets in your futures trading account and all of your positions are getting margined at the same time. So that means if one loses, it can be actually paid for by other positions that may be winning and have equity and collateral there. So it depends. But obviously, if this one goes down, it may wipe out your other positions. If you're just trading very simple trades, looking at prices, maybe isolated is the best thing. If you're a little bit more advanced and you're using some hedging strategies, maybe you have some short positions with the actual underlying collateral of the assets. If you're taking a short position in Bitcoin, but you have Bitcoin to fund that, maybe cross is a little bit better. That's how we fund our positions, but we also have to figure out how much leverage that we want to take in our positions as well. So leverage simply means how big is your position size versus how much cash you have to pay for it. And so you can choose how much leverage that you take, and it's just cash to pay and position size. So if I use a 10x, let's say I open a $10,000 position and I use 10x leverage. What that means is that $10,000 position is being funded by $1,000 because it's a 10x my $1,000 cash. So I have cash, $10,000 trade, 10x 1,000 is $10,000 trade. If I open that same $10,000 trade, but I use 2x leverage instead, all this means is that I'm 2x my collateral value. So if I want a $10,000 trade, I have $5,000 that I need in cash to pay for that position. This increases risk or decreases risk. So with 10x leverage, that means that a 10% move wipes out your collateral, right? Because let's say you have a $10,000 trade, $1,000 to pay for it. A 10% move wipes out $1,000 off that $10,000 trade, your collateral is wiped out. With 2x leverage, you have less risk of loss because you have a $10,000 trade, you lose 10%, that's $1,000. You've made a $1,000 loss, but you've still got $4,000 of cash there anyway. So it's less risk of loss when you use lower leverage. This also is important when you're deciding how to trade, because with futures, if you are speculating, usually with futures, people will have an entry price and a stop loss price. Because if you're using leverage and you're trading in futures, this is not trading the spot market. It's not really investing. This is trading prices, much more short term. So people will usually have an entry price and a stop loss price where they say the trade is wrong and I have to get out and take a loss. So you can enter this, and I'll show you how to enter this. But as an example, let's say that we get into a long position at this price. And we look at the TA and we say, look, the normal volatility could easily bring the price down to this level. And so if I take the actual price difference here of between this and this, let's call it 10%. So that's a 10% move that I think could happen. Now, if I'm using 10x leverage, that means that I'm going to get wiped out at this level. My collateral will be wiped out by Kraken when they say, you've lost 10%, you're using 10x leverage, you have no money left to pay for this position, we're going to sell out the position and concrete your loss. So what I would do is use less than 10x leverage here so that the liquidation price would be below my own stop loss. Then it doesn't really matter what the leverage is that I'm using. I could use 2x leverage, but I'd be paying for more of the position than I need to. I'd be tying up more assets in this trade than I need to. If my own stop loss is here, then I can use 9 or 8x leverage and not increase my own risk of loss because my own stop loss, my own sale price is this level. Well, I'm going to take a loss. That means I can use higher leverage and not increase the risk because I've got my own stop loss here, and I can use the extra capital elsewhere. I can stake it, or I can earn some yield on it or something else. I don't need to tie up my assets in that position, and I can use it somewhere else to actually earn some yield in DeFi or something else, or just use that capital in a better way. So that's how professionals would use leverage. If you're just going to leverage up your assets and take very high risky positions with high leverage, that's obviously just increasing risk. But always have an entry and a stop loss for your trade, and then you can figure out how much leverage that you can take without actually increasing your risk of loss versus your own stop loss trade. Now I'll show you a sample long position. I'll trade the Bitcoin futures contracts here. Everything is valued in USD. So Bitcoin perp means Bitcoin USD, ETH USD, and so on. So from here, I'll be using 2x leverage with an isolated position. I'm going to open a market order just to get the trade done. We're going to open a trade size around this. So we're opening a trade size more than the cash that I have on account. And if you want to take a stop loss, you can. So for me, I say that if I open a long position here, the price could easily come in this range normally. And I don't want to stop myself out here. I'll stop myself out around this price, 85,000. Like this, and it tells me what loss that I would make. So because I have my own stop loss in, if I open a position and then stop myself out at 10% loss, I can also choose how much leverage that I take to make sure that it's not going to be too much, so that the liquidation would be underneath this rather than within this. If the liquidation is within this, I'm using way too much leverage. So from here, We can open our position, just confirm that, should open the position for me, and then you can see it down here. So I've got a Bitcoin long, tells me I'm long. We say long instead of buy because we're not actually buying the asset, we're just taking a position that benefits from the price going up, which is known as long. So in order to take my profit, I need the price to go up, and then I actually take the other side of the trade and sell out, which neutralizes my position, then I have no position. So I'm a long, which means that I essentially bought it. I want the price to go up, and I make losses when the price comes down. You can see the opening price and the current price and my estimated liquidation. My estimated liquidation is where I don't have enough cash to pay for the position anymore, which is 48,000, which is totally miles away from my own stop loss. So I've got no issues there. On the right hand side, if you can just see that above my head, this is where your take profit and stop loss are. So you can change that. Now there's an icon here with 3 dots. So I'm just going to click that, and you can change your isolated margin. This is important if you want to pay off some of the position. So if you're using a lot of leverage, which means you don't have a lot of margin to pay for potential losses, you can change that here, and you can actually add it. You can add margin in. So you can see here my leverage. I'm using 2x. I'm going to increase this up to 5x. Now you can see my estimated liquidation right now is 48,000. I'm going to confirm changes, and my estimated liquidation has now moved up to 77,000. I'm using more leverage, which means I actually took dollars out of that position, out of that trade. And so I have less cash to pay for potential losses in that trade anymore. I can also go to these 3 dots just above my head here. You can't see it right here. Just here is there 3 dots. So I'm going to click that. It says change isolated margin, and let's move it back down to 2x like this. Confirm changes. You should be able to see that the estimated liquidation now moves away again. So I'm literally taking dollars in and out of the trade to change how much leverage that the trade is in relation to my cash. So that is how, let's say the price moves down here and I make a decision that I actually want to start funding this trade. I don't want to stop myself out and sell. I want to fund the trade. You can go down here to your estimated liquidation on the right hand side, click that and change how much cash you have to fund that position. You basically pay off the position and move down your liquidation price, right? Because if you pay for 100% of the position, if you're using 1x leverage, then the price can fall 100%. You can pay for it, or you just bought the position at that point. So that's up to you how you want to change the amount of collateral and leverage that you have in your trade. So from here, if we go to this icon right here, so TPSL, we're going to click that, and it shows us all of the trade. So it shows the trade size and the opening price and everything like that. From here, you can also change your margin and leverage like we just saw. And I'll click off of that as well. I'll just click this back on. And we can change the profit currency. So at the moment, the profit currency is USD, but maybe you want to change that. I don't want to change that. Just keep it as is. So that's my position, and it's open. And I make a profit or a loss. You can actually see that down here when making a profit or a loss. And so what we're going to do is trade out. So click this, and we can close that position. It's going to ask how much do you want to close. So you don't have to close the whole position. Let's say you opened a $10,000 trade, you made some money, you want to take some money out of that trade and actually realize some profits. You close the position. So you don't sell. That's not how we call it with futures. We open a long and then we close some of that long. If you want to close half the position, just choose whatever you want to close and you can close it. That takes profits and closes some of that position but leaves the rest open. So you can do that if you want. I'm just going to close the whole amount and I'm going to close with the market order. But again, you can choose limit order if you want a specific price or a take profit level. But I'm going to close, and that should close out my complete position, and now I don't have a position. Now I'll show you a sample short position, which is a mirror image of the long. So with short positions, what you're essentially doing is selling first, hoping for the price to fall to buy back lower and close your position. And you make a loss when the price rises. So it's essentially like taking a sell position in the asset, but we're not actually selling the asset, which is why we call it shorting, going short. So going short the asset, hoping for the price to fall. When you're buying, you're going long, hoping for the price to rise. So our stop loss here now has to be above the price because we're taking a sell position. So we're going to sell. We're going to open the same amount of leverage here, and our stop loss now should be above, like that. So the stop loss will be above our entry price because if the price goes up, we actually start losing money because we've sold and we need to buy back higher, which is selling low, buying higher, which is obviously not what we want to do. So we're going to open that, sell BTC perp, confirm. You can see that short position in now. It says side short. Here's our open quantity and everything like that. And you can change around the margin and the amount of collateral that you have in your position. But you can now see that the estimated liquidation is now above the price. That's when I wouldn't have any more money left to actually buy back. Right, so that would liquidate me above the price now. So all the same, but I'm just going to, on the right hand side, press the X, press close the position. Notice that I'm closing the position is green now because I took a short position first. I have to close it with a long position on the other side. So close, confirm, and that's out. I showed you a long and a short trade using dollar collateral to fund the trades. So up here, I've just got some dollars in my account or a stable coin. That's what most people will use when just speculating on the price or trading around because it's much easier to figure out how much actual money that you have to fund your trades. So if I put $1,000 in the account or USDT, that is always going to be $1,000 because the assets that we're trading, we are trading these versus dollars, which means we're paying wins and losses and exchanging wins and losses in dollars. So if I've got $1,000 in my account, I know I always have that cash there to pay. And it makes it very easy to work out the potential leverage that I'm taking, the potential volatility that I can handle, etc. That's what most people will use. However, there is another way to do this, which is actually putting crypto collateral into your account to fund your positions. So instead of using 1,000 USDT, how about I use Bitcoin and I put 1,000 USDT of value there? That can happen because all Kraken does is takes the US dollar value of the Bitcoin and it uses that US dollar value to fund my positions. So every second it will mark to market the price of Bitcoin and tell me how much value that I have. So I can do that. What's the dangers here and the benefits? Coin collateral, you put Bitcoin on instead of dollars. Bitcoin is a risk asset and we're trading everything against dollars. And so the dollar value of Bitcoin is the amount of actual value that I have to fund my positions. But Bitcoin can go up and down in value. So as an example, if I take a long position and I have Bitcoin as collateral and the thing goes down in value, not only is my trade losing, but my collateral is losing value as well because the Bitcoin USD exchange rate has gone down. So that makes things extra volatile to the downside. However, if you're taking a long position in a bull market and the price goes up and you take a long position with Bitcoin as collateral, you make exponential returns because now your trade is winning in Bitcoin terms and also your collateral is going up in value in USD terms as well. So that's like extra volatility to the upside in a bull market. So that obviously increases volatility a lot when you're using coin collateral. You can increase volatility because the coin itself is getting marked to market every second as well. But it lets you take positions without going into dollars. So a lot of people that have been around for a long time or you have a lot of assets, you don't want a lot of assets in dollars. You want your assets in assets, right? Bitcoin and whatever else. And so you don't want to sell the Bitcoin into dollars to then trade with it. And so a lot of people who've been around for a long time will use coin margin, but the volatility is higher, so they have to use way less leverage. Now, the other side of this is if you want to use your assets and actually hedge them. An example of this would be, let's say that I've got Bitcoin as collateral and I think we're falling into a bear market. I think prices will be very soft. I don't want to sell the Bitcoin for various reasons. You don't sell assets and it may have a tax liability for you. Maybe you use it to take a futures trade. So you can put collateral as Bitcoin in your account and you take a short position like this. And so, yes, the Bitcoin maybe will fall. Let's say that the Bitcoin does fall in price and the Bitcoin makes a loss. But if you have a short trade, you're benefiting from the price going down because a short trade is selling there and it makes money as the price falls. So your collateral moves down, but your trade moves up into profit. And so it cancels each other out a little bit, known as a hedge. You're hedging your position with the underlying asset. Now you can do all of this with dollars, but like I said, people that have a lot of assets don't want to switch them all into dollars to trade. That's well, they want their assets, they want to keep the assets. They're just trading around the edges, either by speculating or hedging, and that's what futures are really for. I'll do some more in-depth videos on day trading and some other strategies down in the description, the Kraken link down there as well, plus some other exchanges that I use. The bonuses for those will be down in the description. I'm James, this is MoneyZG. Cheers for watching, and I'll see you in the next one.